Every owner plays two financial games. Most only know one. That game is tax accounting, which is making the number on your return as small as legally possible. That's your CPA's job. The other one is profit accounting. Make the number in your bank account as large as possible. That's your job. Here's the trap. These two games pull in completely opposite directions. Pay less tax, you have less profit. Less profit is less owner pay. Less owner pay means a smaller business, and a smaller business means a smaller exit. So let's flip it. There are only two rules you need. Rule 1, always want more profit. Rule 2, always be prepared for the tax that comes with the profit. If you do those two things, you'll never have to fear tax season again, ever. Here's why most owners get this wrong. Their CPA tells them in December, not earlier in the year, buy a truck and you'll save on taxes. So they spend 60 grand or more to save $15,000 in taxes. And you feel good and smart. But you just took $45,000 of real money out of your pocket to dodge a bill. See, that's not strategy, that's surrender. Profit accounting flips that order. So profit comes first and tax follows profit. That order is locked in. Now here's the rule you can run on a napkin. Every gross margin dollar splits 80-20. 20 cents goes to your tax reserve. And the moment that dollar hits, 20 cents goes into a separate account, preferably at a different bank. You don't see it, you don't touch it. It's not your money, it's the IRS's money sitting in your custody. The other 80 cents is yours to deploy to labor, to marketing, to overhead, to owner pay, and profit. And yes, owner pay and profit are two separate things. That's where you run the business. So here's a quick explanation if you don't know what gross margin is. Gross margin is what's left over after you take revenue and subtract materials or cost of goods sold, not labor. Remember, it's cost of goods sold. Think about that. It's the real money that the business produces. So tax follows profit, and profit lives inside of that 80 cents. 20 cents is on purpose. It covers the tax in almost every scenario for a business under $5 million. Worst case, you over-reserve and you have a cushion at the end. That cushion doesn't just disappear. It rolls into core capital or paying down debt or funding your next hire or even better, a distribution. Nothing happens when you have extra cash in tax reserve. The only bad outcome is under-reserving or not reserving at all. 20%, it removes that risk. Now compare two owners. Owner 1 writes off everything, buys the equipment they don't need, runs profit to zero, and pays almost no in tax. Also, has no money. They can't pay themselves, they can't grow, and they can't sell. Does that sound familiar? Owner 2 makes a real profit, reserves 20 cents of every gross margin dollar, and pays the tax from that reserve. Still has money in the bank, still pays themselves a real wage. They can also fund their next hire and can build an exit-ready P&L. Same revenue, same business, two completely different lives. Your accountant works for the IRS. Your numbers should work for you. Your CPA looks in a rear-view mirror. EasyFlow CFO looks straight through the windshield. Stop trying to win in April only. Start trying to win the other 11 months of the year. Remember, two rules. Number 1, want more profit. I mean, who doesn't want more profit, right? Kind of sounds crazy to say that out loud. But most importantly, 2 is to reserve 20 cents of every gross margin dollar for the tax that comes with it. You do these two things and taxes stops being a crisis. They become a line item. If you make stuff, do stuff, or sell stuff, grab the profit and tax calculator at easyflowcfo.com/free. You just punch it in, the information, and you can see that, yeah, you can either pay less in taxes or you can put more in your pocket. It's your decision to make. And you'll be able to see that simply and easily. And it's a free download. I'm Nick, the Fractional CFO. Your numbers made easy.